And finally, here it is. At the beginning of earnings seasons, many asked me to do a video comparing the four biggest banks to see which one did better and which one would be the best investment. So here it is. Hello everyone, welcome back to the channel. Today, we will talk about JP Morgan, Wells Fargo, Bank of America, and Citigroup. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Before starting with the analysis, I have something very important to say. All of my videos are entertainment purposes. None are investing recommendations by any means. I know that every YouTuber says this on their videos, but we still get a lot of comments because of people that bought a stock that we talked about, and obviously with this crash in growth stocks, we receive way more comments. I just want to say this because we are not financial advisors. I would never recommend you buy or sell any stock I talk about in any of my videos because I don't even invest in all of them. I just share my analysis and investing trajectory, and obviously I try to be as transparent as possible and say when I'm investing in something and if I'm making or losing money in any of my positions. Just wanting to make this clear once again because as I have said before, if you lose money in any of these stocks you bought because someone is investing in it, no one will pay you back that money that you lost. So don't play with your money and invest in things that you like and understand. If you want to use any of the YouTube videos for your research process, fine, but don't make a decision only by watching YouTube videos and because they are investing in these companies. Now, let's start with the video. We all know that the banking industry got affected when people lost their jobs and faced salary cuts due to the pandemic. But even though the unemployment rate is at 5.77%, people are kind of back to work. First and biggest bank in the United States right now is JP Morgan Chase. It is currently trading at $154.17 per share with a market cap of $460.9 billion, a forward PE of 13.09, a price result ratio of 3.58. They report a revenue of $31.39 billion for quarter two, which is a decrease of 5.2% and 7.16% quarter over quarter and year over year respectively. They did miss expectations in revenue but beat in earnings as they reported a net income of $11.9 billion, a decrease quarter over quarter but a growth of 155% year over year as last year they were having a high provision for credit losses. This is an important metric to check on banks and even more during any crisis like the pandemic, as that is the amount of money that the bank expects to lose in credit cards or loans, so it is an expense for the company. But this year was a benefit for the company in comparison to last year, which was an expense as those funds were now released. As you can see, they had an expense of $10.4 billion a year ago, and since last quarter they have been releasing as it is not an expense anymore, and that is why it is shown as a negative factor in the chart, which is why that helped with the increase in net income as well. JP Morgan is a nice dividend stock with a dividend of 2.33% and the payout ratio has decreased, which is always good to see and healthy for any company. Analysts are still expecting a decrease of 0.10% in revenue for the whole 2021, even though 6 months ago they were expecting a decrease of 5%. Second biggest bank is Bank of America. It is currently trading at $40.24 per share with a market cap of $338.5 billion. A forward PE of 13.36 and a price to sales ratio of 3.90. Reported a total revenue of $21.5 billion, which is a decrease year over year and quarter over quarter as well. They did mention that their revenue declined from a year earlier because of a 6% drop in net interest income due to lower interest rates, which is what I have said before. Banks are the most affected by low interest rates, and even though that was already expected, they still missed revenue and earnings expectations from analysts as they reported a net income of $9.2 billion, a growth year over year as they are also having a benefit for credit losses since last quarter of $1.6 billion. Because again, we are almost back to normal, even though the Delta variant is hitting hard in different parts of the world. Bank of America does have a lower dividend than JP Morgan of 2.09%, but in my opinion, it is still very nice. Their payout ratio has also decreased. Now, analysts are expecting Bank of America to have a revenue increase of 2.50% for this year. Third bank is Wells Fargo, currently trading at $46.94 per share with a market cap of $192.6 billion, a forward P of 12.97 and a price-to-sales ratio of 2.52. Wells Fargo reported a revenue of $20.2 billion, which is an increase both year over year and quarter over quarter, surprisingly. Reported a net income of $6 billion, a very nice growth as well, as provisions, well, in this case, benefit of credit losses was $1.2 billion. Wells Fargo beat analyst expectations in both revenue and earnings, which is obviously incredible in comparison to the two other banks that we just analyzed, which kind of show that they have improved a lot as a bank. Now, I used to invest in Wells Fargo a year ago as the stock dropped a lot and it was the cheapest bank among the four of them with the most potential in my opinion. I remember that I was down like 50% because I started investing back before the pandemic and many didn't like the company, but I don't know why. I was seeing the potential and the stock has been the top performance in the past year with a return of 95%, which shows why to not panic sell or hold long term is a good strategy with good companies. I closed that position as I was in it for the potential of getting back to these current numbers and because of their dividend, as they used to have a high dividend yield of about 3.5 to 4% between 2019 and the beginning of 2020, which was very attractive. But with the pandemic, as they were suffering the most, they were the first ones to reduce the dividends. And obviously, many did not like that. But now, they have doubled its quarterly common dividend from 10 cents to 20 cents per share after cutting the dividend 80% last year, which is a 1.69% dividend yield right now. For this one, analysts are expecting a revenue growth of 3.90% for 2021. Last but not least, we have Citigroup. It is currently trading at $69.82 per share with a market cap of $141.5 billion, a forward P of 8.99 and a price-to-sales ratio of 1.97. Citigroup reported a revenue of $17.4 billion, which was a decrease of 10% quarter over quarter and 12% year over year, meaning that Wells Fargo was the only one that saw a growth in revenue. They released $2.4 billion and reported a net income of $6.1 billion, but still were able to beat analyst expectations in both revenue and earnings. Now, Citigroup has a dividend yield of 2.92% with a nice price-to-sales ratio, and analysts are expecting a revenue decrease of 4.80% for 2021. With all that said, let's compare this for stocks. First of all, we already saw that the winner for stock performance was Wells Fargo with a return of 95% in the past year. Second place for Bank of America, and so on. Then for the revenue expectations, we saw that the best one was Wells Fargo with a growth of 3.9% for 2021, which is obviously nice but weird at the same time as companies like Square are actually expected to grow massively over 100% for this year 2021. For the next metric, their forward PE, which helps us understand where the company is heading in the year's measure, and for this rate, the lower the better, meaning that the winner here is Citigroup. Then their PEG ratio, which is the association between the company market value and its projected earnings growth, and everything above 1 suggests that the stock might be overvalued. So because of this metric, the winner of this metric is Wells Fargo once again. Last but not least, their dividend, which even though it does not tell us if one stock is a better investment than the other, valuation-wise, it is very important for dividend investors as they are looking for a higher return. So the winner for this is Citigroup with a dividend yield of 2.92%. After comparing these companies, we can see that the winner is surprisingly Wells Fargo, with the best stock performance in the past year, best revenue expectations growth, as it is one of the only ones that is expected to actually grow this year, and has the best PEG ratio. I do have to say that it is the one with the lowest dividend yield, but overall it seems to be the best one. With all that said, I believe all of them are nice investments for dividend investors, but if you ask me, I'm not a dividend investor. I prefer to invest in Square, as I can see more growth potential in that company than these banks, but obviously that is because of my way of investing. Many yours is different. I might prefer banks. Hope this was a fun video for you guys. It is always fun for me to make it on a quarterly basis. Please smash that like button and subscribe, since it really helps the channel out. Thank you, and see you next time.